Hello and Happy New Year. I hope you had a wonderful holiday season. Today is Friday, January 13th, 2017, and in about 3 minutes I will share with you a brief overview of the markets last year, and I will review our outlook for 2017. So as I mentioned in a recent blog post called Key Takeaways from 2016, last year was quite a year on many fronts. Undoubtedly, there were a few very low probability events which were expected to cause the markets to sell off substantially should they occur. And we now know not only did they occur, but the exact opposite happened in the markets. I'm talking here primarily about the Brexit vote in the UK back in June and our presidential election here in November in the US. Last year, everybody's crystal ball broke. And this is when I remind you that nobody's crystal ball works, unfortunately. The biggest takeaway from me last year was that unexpected events can occur and can even spook the markets in the short term, but outside and stronger forces can come in and quickly push them back up. So that brings me to this year, 2017, and what we expect. LPL Research recently put out their 2017 outlook, and here, high level, is a summary. For the economy, based on low probability of a recession this year, according to leading economic data, we expect the economic recovery that began in 2009 may pass its 8th birthday. However, the risk of a recession due to a policy mistake, think monetary, fiscal, trade, immigration, has increased heading into 2017. For the international stock markets, although fundamentals and valuations have been improving in both developed as well as emerging market equities, there are potential global geopolitical risks to be cautious about. For the U.S. stock market, we expect S&P 500 gains to be in the mid-single-digit returns, driven by 1. A pickup in U.S. economic growth, 2. Mid to high single-digit earnings gains as corporate America emerges from its year-long earnings recession, 3. An expansion in bank lending, and 4. A stable price-to-earnings ratio, or PE, of between 18 and 19. Gains will likely come with increased volatility as the economic cycle continues to age, so we need to be prepared for that. For the U.S. bond market, we expect an uptick in inflation due to President-elect Trump's infrastructure spending plans, anticipated fiscal stimulus, and potential Fed rate hikes to possibly put pressure on bond prices in 2017. Ultimately, we expect low to mid-single-digit returns in the Barclays Aggregate Bond Index. So in conclusion, the current expansion, which this year will be in its 8th year, is the 4th longest since 1900. So it's important to remember this is an aged expansion. There are many reasons to maintain positivity and optimism for 2017, but also plenty of reasons to be cautious. Thank you for taking the time to watch this as always, and if you have any questions, please feel free to reach out. Take care.